Hello everyone, I'm Linda J. from Buck Jones Taxes. Today we're diving into one of the biggest tax changes in 2025, the new expanded state and local tax deduction, better known as SALT. This change could mean thousands of dollars in savings for many taxpayers. Additionally, I'll also touch on other deductions you'll want to keep in mind for 2025 and beyond. For years, the SALT deduction was capped at $10,000. That meant if you paid more than $10,000 in state income taxes, property taxes, or certain personal property taxes, you could only deduct up to $10,000 and the excess kind of went to waste. Now, under the One Big Beautiful Bill, the cap has been raised to $40,000. That's a huge jump. But here's the catch. You must itemize deductions to take advantage of SALT. And once your adjusted gross income exceeds $500,000, the benefit starts to phase out. If you are a married couple filing separately, you don't get the full $40,000 cap. Your deduction is capped at $20,000. And once your adjusted gross income exceeds $250,000, this benefit begins to phase out. So if you haven't itemized in recent years, this increase may make it worth reconsidering. Here is a quick refresher on what counts towards SALT. State and local income taxes, property taxes on real estate, personal property taxes for things like motor vehicles, cars, trucks, motorcycles, boats and aircraft, recreational or commercial, business equipment, computers, furniture, machinery, tools, mobile homes, if not permanently affixed to land. In some jurisdictions, livestock, art, collectibles, or leased equipment. Or instead of income taxes, you can choose to deduct general sales taxes. This can be beneficial when you live in a state with no income tax, like Florida, Texas, Nevada, or your sales tax payments are higher than your state income tax. For example, if you bought a new car or made large purchases. Or your state income tax is relatively low, but your spending subject to sales tax is high. The Tax Cuts and Jobs Act raised the standard deduction, and the One Big Beautiful Bill makes this increase permanent. For 2025, the standard deduction for single filers is $15,750. For head of household, the standard deduction is $23,625. And for married filing jointly, the standard deduction is $31,500. If your itemized deductions are close to these amounts, you may want to consider bunching deductions. How this works is you double up on charitable contributions, pay what you anticipate paying in 2026, in 2025, maximizing your charitable contributions itemized deduction, or making medical payments all in one year to maximize your medical deduction benefit this year. Then next year, you can take the standard deduction. With this strategy, you maximize your itemized deductions in 2025, and you still get a big standard deduction in 2026. When you itemize, keep in mind that medical expenses are only deductible if they exceed 7.5% of your AGI. This includes insurance premiums, transportation for care, and qualified long-term care. When it comes to charitable contributions, donating appreciated assets like stock can give you a double benefit. Doing this will allow you to deduct the fair market value and avoid capital gains tax on the money. With interest rates at an all-time high, deducting mortgage interest can provide big tax savings for the ones who have a high-interest loan. Mortgage interest is deductible on home balances up to $750,000 with specific rules for refinances and home equity loans. You can deduct up to $2,500 for student loan interest, even if you don't itemize. When you sell your home, you can exclude up to $250,000 of gain or $500,000 for married filing jointly if you meet residency requirements. The bottom line, the new $40,000 SALT deduction is a game changer, especially if you live in a high-tax state. Even if you haven't itemized in recent years, now is the time to run the numbers. Itemizing could save you thousands off your tax bill. Thanks for watching, and let's make sure you're taking full advantage of these new rules. Visit us at buckjonestaxes.com.